Welcome to our Final AGM presentation. We are Andrew 63. As we prepare to hand our business on to the next set of executives, we would like to review our strategy and share our results from the past 8 years.
Strategy, niche, cost leader. With a focus on the traditional and low-end segments, our aim was to sell at least 2 products in each of those segments. Our products, Acorn and After, are in the traditional segment, while Able and Acre are in the low end. Part of our strategy was to pass our savings down to our customers and build a strong customer base. We placed our products to have the lowest price, an average of 50 cents cheaper than our competitors. We maintained our low-cost strategy by having low material, labor, and admin costs. We achieved this by keeping a low MTBF, investing in automation and TQM initiatives. We spent a total of $28 million on several TQM initiatives that helped reduce costs, increase demand, and help with our R&D cycle time. Low cost doesn't mean low spending. There was a misunderstanding of what our strategy entailed. Therefore, we didn't spend as much on advertising and sales compared to our competitors. This resulted in us having a low awareness and accessibility score for most of the rounds. Our strategy was meant to keep R&D costs to a minimum. However, due to our existence within the high-end segment, our R&D costs were high in that particular segment. We did this to stay competitive amongst our competitors.
Our evolution as a company was similar to that of a business cycle with peaks and troughs. Here are some of the major milestones. The first few years of our business, we started off really strong with a total of 5 products, 1 in each segment: low end, traditional, performance, size, and high end. We initially decided to be present in all segments to maximize on sales, revenue, and profits. This was effective for the first few years while competition wasn't as stiff. We were able to maintain a high overall market share and raise our contribution margin while also having strong financials with high ROE, ROA, and leverage ratio. However, as the years went on, each segment started to become more saturated and competition became more tough. We realized we wanted to focus on the traditional and low-end segments. It was a perfect match for us as we were doing really well in those 2 segments, and the characteristics of those segments matched our low-cost strategy, which was less changes in R&D and preference of low prices. We shifted our product aft from the performance segment into the traditional segment. This was the most viable option as it costed us less to shift the product than create a new one. However, we had to sacrifice on time spent in making those R&D changes. It took us approximately 2 years to shift into the traditional segment. In addition to the changes in our product aft, we also made changes to our high-end product to match ideal values, making it in line with what our competitors were doing in that segment. This R&D project took us over a year to finish. While all of these R&D changes were taking place, we only had 3 viable products selling. This is when our company took a big loss in sales, profits, and contribution margin. The loss in profits also come from our poor production forecasting. We stocked out a total number of 15 times, and the times we didn't stock out, we usually had a large number of units left in inventory. Looking back, we should have put a closer eye on what our competitors were doing, as it would have helped with the production planning.
By year 5, we slowly started to recover some of our lost market shares as our new traditional product and high-end product finished revision. As a result of higher demand, our overall sales started to grow continuously over the next few years. Unfortunately, we were still making a loss, and this has resulted from our low contribution margin. Compared to our competitors, we weren't spending enough money on automation levels as we did not make enough profits to support our executive decisions. The accumulation of lack of investment in automation caused our contribution margin to spiral down year after year. We realized the urgency of the situation and decided to heavily invest in TQM initiatives, such as quality initiative training, CPI systems, benchmarking, and just-in-time. These initiatives help reduce labor, material, and administrative costs. and slowly help bring back our contribution margin. We also found our investments in HR training to be helpful with reducing our per unit labor cost. On average, we spent $2.4 million each year on recruitment and training.
Overall Year 8 review. Year 8 was a recovery year from Year 7. The biggest success our business had was a total yearly profit of $12 million. This is the highest profit we've ever made and is a significant turnaround as our previous year had a total loss of $2.3 million. Additionally, this success rose our stock price by $23.10 from Year 7, giving us a total stock price of $44.91. Another success of Year 8 was an increase in our bond rating from a CCC to a BB, and a raised contribution margin from 28.3% to 32%. Large investments in HR and TQM provided strong results in Year 8. A total of $5.5 million was spent in TQM through a variety of initiatives, including the Global Environment Management Initiative, quality function deployment efforts, benchmarking, and concurrent engineering. This investment aligned with our niche cost leader strategy by focusing on decreased material costs and raised efficiency in our production. However, one of the biggest failures of this year was the stockout we had for 5 out of 6 of our products. Lack of planning and investment into production left us at a disadvantage as we lacked capacity in some products. The effect of this was lost market share, which ultimately affected overall profits. This meant we had a total market share of 12%, with the majority of it coming from our products Aft and Acorn at 25% in the traditional segment, and our products Able and Acre at 16% in the low-end segment. Research and development was an area of constant investment. However, we failed to expand these investments through TQM funding. However, overall, Year 8 leaves the company in good standing for future success despite these few failures.
The most important lesson we learned was to invest early rather than later. Initial fear of overinvesting in marketing and production affected our awareness, accessibility, and contribution margins long term. If we invested in capacity and automation sooner, we could have avoided stockout costs and loss of profit. We weren't producing as much or as efficiently as possible. Additionally, not enough emphasis was put on watching our competition closely. Instead of staying one step ahead, we were often lagging behind. This resulted in spending bulk amounts of resources to catch up and remain competitive. While hard, these lessons were well learned and the team implemented them in future decision making. We recognize that there was also a lack of understanding and use of available resources such as the debrief and analyst reports. We would like to have a better understanding of the impact of financial ratios to better take action moving forward. The performance of any business is dependent on the efficiency of their teams. The roles of each member were assigned by taking into account personal strengths and how they fit within the goals of the team. Our business had no hierarchy, and our organizational structure was divided by product. Each member specialized in a product: Able, Acre, Aft, Agape, and Atom, and we all came together to make decisions on finance, HR, and TQM. This allowed for equal distribution and allowed each member to be accountable. While making business decisions, the team was responsive and reactive to any arising issues through constant communication and was careful to ensure that there was always a contingency plan in place in the case of fallout. Overall, the team worked well together to make decisions they believed would be best for the company.